All right, we're back. I'm in the same outfit because we're filming the same day. Okay, I've been slacking on the videos a little bit, and we're gonna get a couple filmed and ready to get posted. So if you ask why I have the same freaking clothes on and I haven't changed, it's because it's in the same day. Okay, in this video, we are going to be going over liquidity. This is something very important for based off of the strategy that I use. And again, hopefully you start to understand liquidity more. We already went over market structure, breaker structure, and also what a high and a low is. We're going to go over liquidity first, and then we'll go over fair value gaps, inverse fair value gaps, so on and so forth, and keep moving on with the strategy that I currently trade. And again, hopefully I help you guys and girls understand the market a little bit better. Again, is this going to make you guys and girls millions of dollars within the first couple months, the first couple years? No. Okay? You need market experience, you need risk management, you need psychology, you need a strategy. That's what we're personally going over right now, the strategy. We'll make some psychology videos and some risk management videos also. But again, trading takes time, okay? Trading takes time from learning from losing money, learning from blowing accounts, learning from doing the wrong things, learning from going back and just studying the markets for hours and hours and hours and hours and hours. I wouldn't want to sit here and lie to you and tell you that you're going to make $1 million within overnight, okay? Even I haven't even made $1 million yet, okay? But again, we're working on growing our accounts. We're building capital. We're building on these prop firms. We're showing the real truth, the real reality of my journey. I'm just here to show you guys and girls what you guys can actually do to start understanding the markets and just keep getting better from there, okay? Let's jump right into the video on learning what liquidity is, all right? Let's go. Okay, so you guys and girls should be able to see these definitions. These are the definitions that I had written out for you guys and girls. We can make this a little bit bigger probably, I would think, so you guys can actually see this. Let's make this 120. But this is the definition that I had written down in my journal. I think this is the best definition that you can help understand. Holy... That can help you understand liquidity more, okay? All right? I'm sorry if I'm a little brain dead sometimes. But this definition, write it down in your book. It'll help you go back when you want to understand what liquidity is again. But again, you're not going to need to mark out liquidity on a chart. And we're going to go over how to mark that stuff out and everything like that and go back and memorize this definition, okay? I want you to understand why you're using this, what it is. And again, personally, this is what I use. If you don't believe in draws and liquidity, it's okay, all right? Everybody has their own trading style. But again, I trade draws and liquidity. I target draws and liquidity. I use reactions off of draws and liquidity because the market usually tends to move to that draw and liquidity that I want to target for the day, okay? That's personally how I studied the markets. It works for me. It can work for you. Go try it out and study it if you want, and let me know after that, okay? So liquidity is the areas on the chart where a lot of stop losses are sitting, usually above highs or below lows. And we went over that in the last video, what a high and a low is, okay? In futures trading, price is attracted to liquidity because that's where buy and sell orders are available, which allows large players to enter and exit positions. So liquidity equals clusters of stop losses above highs and below lows that price is drawn to. So when we mark out a draw on liquidity, okay? Price usually tends to trade towards that draw on liquidity, right? Because people have their stop losses, let's say above the most recent high, right? Let's say we have an hourly high above, which we're going to go over. Price usually ends up targeting that area to target those people's stop losses because they have their stop loss above that high because they don't think price is going to continue higher. They're predicting the price to go down, correct? So price comes up, sweeps out that high, stops out all those people, and then the market makers end up filling in their orders, continuing price in the down direction because they can fill all those orders in a cheaper area and send price down in the direction they want to so they can make more money at the end of the day, okay? So how do we identify what draws and liquidity to target? Let's just go over the way I mark out liquidity. And again, this is how I use it, okay? And you can also use, I use previous day highs and lows, session highs and lows, which means Asian session, London session, New York session, 4-hour highs and lows, hourly highs and lows, 15-minute highs and lows, 5-minute highs and lows, 1-minute highs and lows. That should be good for now. I usually don't use weekly highs and lows. You can, but again, I usually just go up to previous day highs and lows because I only trade New York session, and that usually tends to work pretty well for me. But again, write those down in your notebook, okay? Liquidity. How do we mark them out? Previous day highs and lows. Session highs and lows, which means Asian session, London session, New York session. 4-hour highs and lows, hourly highs and lows, 15-minute, hourly, 15-minute highs and lows, 5-minute highs and lows, and 1-minute highs and lows, okay? And we'll go over in the future how to use those. There's a strategy I use with the 1-minute highs and lows, but again, I use that with an SMT after we scale down a little bit to look for my entry. But again, the main ones I mainly focus on coming into market open are 15-minute, hourly, 4-hour session, and previous day highs and lows, okay? Write those down, all right? We're about to exit out. 3, 2, 1. Goodbye, goodbye, and goodbye. All right, so let's go over on the charts. How do we mark out highs and lows? Okay, let's Let's go to New York session. All right, we'll back test. We'll go to Friday, start new. And Friday, I missed a perfect trade, like a doofball, but it's okay. But we're going to show you how to mark out our session highs and lows, okay? All right, so we're going to mark out 9:30. So how do we come into market open? Like I said, when I come into market open, I usually look for previous day highs and lows, session highs and lows, and 4 hour, 1 hour, 15 minute, usually, okay? So let's start with 4 hour. It's a little bit different because, again, we're back testing, so it's going to show this 4 hour candle when I marked out 9:30. But again, we're going to look for our 4 hour highs and lows, okay? So look, we have a 4 hour high here, right? Bullish candle, bearish candle closure. I shouldn't have to go over that again because you watched the last video. We're going to mark out all our 4 hour highs, right? We have a 4 hour high here that already got swept. Again, if the 4 hour high has already been swept, we don't pay attention to it. We want to mark out the highs and lows that haven't been swept yet so we can look for either a reaction off of those areas or draws and liquidity we can target, correct? Where else do we have 4 hour lows? 4 hour low here, 4 hour high here. We didn't create this 4 hour high yet because this candle's still printing. We have a 4 hour high here. Do we have any other 4 hour lows? We have a 4 hour low down here, which I doubt price will probably go to. Boom, right? What do we do next? We go to the hourly time frame, okay? Now we look for our hourly highs and lows. What do we have? We have an hourly high here, which gets swept on market open, and we'll mark that out. Let's disregard this candle. What else do we have? We have an hourly high right here, right? Bang. We have an hourly low right here. Nope, not here. This one was already swept, so we don't mark it out. This one was already swept. We don't mark it out. This one hasn't been swept yet, so we have an hourly low here. Okay. And then we have another hourly low right here. Boom. And then has this one been swept? Nope. We have another hourly low right here. We can mark out. Hasn't been swept yet. We have another hourly low down here. Another hourly low down here. Again, it's pretty simple. This is what you guys and girls should be doing. Just marking out your hourly highs and lows. You should already know what a high and low is already. Again, we went over in the last video. We have another one here. And then boom. That's pretty much how I would start market open. We have another hourly high right here that hasn't been swept. And then we have an hourly high over here that hasn't been swept. Okay? Boom. This would be enough for me. I wouldn't probably mark out any 15-minute highs and lows because, again, we already have a bunch of 4 hour highs and lows and we have a bunch of hourly highs and lows. If you guys and girls want to, well, again, you're going to need to mark out session highs and lows. I have this indicator over here that I currently use. It's called ICT Kill Zone, and I could show you my settings also. But all you have to do is show it, and it'll show you your London session, right, which is this orange line. So I have it built over here in my tools, London session. We have London session lows right here, and then we also have Asian session lows down here, right? Asian session lows. Boom. But this is called ICT Kill Zone. I'll go to my settings for you. These are my settings right now. I only have London and Asian session marked out. Here's the time. Here's the colors I use if you personally want to use those. You should be able to see that. And then, yeah, if you guys just want to be able to do that, it's easier just to click this button and it marks out the highs and lows for you for London session. Okay? Boom. So now we have London session, highs and lows, okay? London session highs, Asian session highs, they're already taken out yet. It showed that. So now we have London session lows and Asian session lows open. What are we looking for? We're either looking for a draw on liquidity we could target, or we're waiting for price to come up, sweep out our draw on liquidity, and then we'll use our continuation confluences that we're going to go over in the future. But we already know what a break of structure is, right? Now we're going to go over liquidity with this example. I'm going to show you a live example right now that happened on Friday, so you guys and girls know this isn't bullshit. Again, does this happen every single day? No. You have to get experience in the markets to understand draws and liquidity, right? If we're going to target them, if we're going to react off of them, if price is going to consolidate, if price is going to continue in an uptrend and we look for continuation confluences, if price is in a downtrend and we're going to look for continuation confluences to the downside. Again, you'll start to use these tools to get more experience in the markets. Does that mean you're going to know everything right away? No. What you need to do is go back and back test and learn, right? I'm showing you the live examples of how you can go back and back test. We just marked out market open, correct? We scaled down to the 4 hour time frame. We looked for our 4 hour highs and lows. What did we do after that? We scaled down to the hourly time frame. We looked for our hourly highs and lows, right? These are our draws and liquidity we're looking for reactions off of. What do we do after that? We look for our London session highs and lows. And if there's not a lot of draws and liquidity like hourly or 4 hour lows, we'll mark out our 15-minute highs and lows, okay? Pretty simple. But let's say we're coming into Friday here, correct? We already know what a break of structure is, so I could show you this trade. I usually scale right down to the 5-minute time frame after finding my draws and liquidity, okay? And we're going to go over time, and we're going to go over the macro and stuff like that. But again, I usually try and find a trade after 9:50, correct? Let's see what happens. Market open is this first line, 9:30 a.m. Eastern time, New York open, okay? What does price do? We come up and we sweep out this hourly high. What would we want to look for? We either want to see if price is going to continue up, target this hourly, this 4 hour, this hourly, or if we're going to get a reversal and we can target all these draws and liquidity that we have down below. What do we wait for? We monitor our lows on the 5-minute time frame, and we wait for our break of structure, what you learned in the last video, correct? Boom. We monitor our lows. Where's our most recent low? Right here. We wait for a break of structure to the downside. We don't get it there. Boom. We get it there. This is showing us we're reacting off of our draw and liquidity that we marked out, and we're going to see if price wants to continue in a downtrend after taking out our high, right? If we're taking out a high, we're predicting for price to go lower. If we're taking out a low for our draw and liquidity, we're predicting for price to go higher. Does that mean it's going to happen every time we take out a draw and liquidity? No. Price can continue up through them if it wants to. The market's going to do whatever it wants, but we use these as confluences to identify if price is going to go in a certain direction, and then we take our trades based off of probability. Is the trade going to play out every single time? No. Okay? Put that into your mind now. We're going based off of probability, and if the trade is going to play out, maybe let's say we have a 60% win rate. We have a 60% chance of this trade playing out. And we also have that other percentage of it not playing out. But we use these confluences like liquidity, the break of structure, our continuation confluences to identify if we can get an entry on if we are right, if the trend is going to continue in a different direction, or if it's going to continue, let's say, up, right? In this case, we want it to continue down. All right, so we see our 5-minute break of structure. Just because we went over break of structure, market structure, highs and lows, and we're going over liquidity, let's just say we take a trade off of break of structure, okay? To show you that this works. We'll put our stop loss above this high. Again, this is not how I trade, right? We're going to scale down to the lower time frames first before looking for a continuation confluence and then take our trades, okay? But this is how you can just look at your trades right now and show you how draws and liquidity work. So we have London session lows down below. We have an hourly draw below. We have Asian session down below. We have this hourly draw and liquidity down below. We have this hourly draw and liquidity down below. Let's say we wanted to target all these draws. We came up on market open on New York session. We swept out our higher time frame draw and liquidity, a buy side liquidity, this hourly. We broke structure in the 5-minute time frame. That's showing us that we have the potential to continue down. Let's see what happens. Price continues down. We got our reaction off of the draw and liquidity we were looking at. Price decided to continue down. Again, we just entered off of a break of structure on this trade. I wouldn't do that personally. Usually I scale down to the 1 minute and I look for our continuation confluences. But this is literally, we targeted London session, this hourly, Asian session, this hourly, this hourly. It's a 146-point trade. That is a crazy trade. But that shows you that this can actually work. Is this going to happen 100% of the time? Like I said, no. But again, we're looking for a reaction based off of the draws and liquidity that we are looking for, okay? And again, we could see, if we want, I'm pretty sure price consolidated after this because, again, the market closes at 4 o'clock, and this is Friday. But you can see we come down, we target all these draws, Again, our trade would be done with, but we could see price just continues down, and it ends up getting a little bit of a reaction off of this hourly low. We think we came into a 4-hour fair value gap. Yeah, we do, which, again, we'll explain in the future. But again, that example we just showed literally shows you that this stuff can work, but what you should be doing is just going back testing this. Mark out your 4-hour highs and lows, your session highs and lows, your hourly highs and lows. Scale down to the 5-minute time frame, wait for market to open, see if price takes out buy side, which is those hourly highs, 4-hour highs, London session highs, and then gets a reaction off of it, looking for a 5-minute break of structure to the downside, and then you'll use our continuation confluences, the more videos we make after this, to identify if you're going to enter a trade or not. But then same thing. Let's say market opens up, we skyrocket down, we take out sell side, which is our 4-hour lows, hourly lows, session lows, 15-minute lows. We scale down to the 5-minute time frame. We look for a break of structure to the upside. Boom. We'll see if price wants to react up and continue higher, correct? So price manipulates, targets that draw on liquidity, stops all those people out, fills in their orders, price continues up. If price is hunting for buy side liquidity, right? Price is going to move up off market open. We're going to take out that buy side liquidity. Market makers stop out all those people with their sell orders above this high, right? Because again, people had their stop loss who were predicting the market to go down. Let's put this in an example. Let's say the people who went short here have their stop loss above this hourly high. So if they get stopped out, the market makers fill in their orders, which is what happens. They stop these people out and then they fill their orders and price continues in the opposite direction, correct? Same thing if we were going to come down here. People have their stops below these lows. The market could target this area, stop people out, and continue higher if it wants to, correct? But as we can see here, People who wanted to go short and hold going short had their stop losses here above this high. I don't know where they entered, but their stop losses were above this high. Market makers come up, they push above this high, they stop out those people, fill in their orders, get a cheaper price, and boom, they push price in the opposite direction on where they want to push price. And again, they get a cheaper price, they can push the market, fill more orders, and push in the direction they want to. And then bang, our job is to get in on a trade like that, identify that they're going to move the market to the downside, take a little bit of a chunk out of the pie, make some money, and then boom, there it is. Again, it sounds more simple than it is. It's easier said than done. But again, what I want you guys and girls to do is go back, mark out on replay trading on TradingView. Go to FX replay, mark out New York Open, 9:30 a.m. Mark that out. Mark out your 4-hour highs and lows, your hourly highs and lows, your session highs and lows, your previous day highs and lows, your 15-minute highs and lows. Look for price to sweep those draws and liquidity, and then just look for a reaction off of those just to identify what draws and liquidity do and how we get reactions off of them. And then we'll go over the continuation confluences as we make more and more videos. We'll go over fair value gaps. We'll go over equilibrium. We'll go over order blocks. We'll go over all the stuff we need to look for our continuation confluences. We'll put all the puzzle pieces together on what time frames I use. Like I showed you here, scaling down to the 5-minute, then we'd scale down to the 1 minute, look for our continuation confluences, and then get our entry because we want to get our entry at the lowest time frame. I personally go down to the 1 minute. Some people go to the 30-second. I just go to the 1 minute, okay? We all trade differently. But again, this is just to show you how price reacts off of draws and liquidity, what liquidity is, and we're going to move forward and show you the continuation confluences, how we can get a better entry off of these draws and liquidity, right? Because again, sometimes it can look like prices are going to continue down and our continuation confluences won't get respected, so we don't take a trade and price could just reverse instantly and go in the up direction and trick people, and that's happened many times. But again, is this going to present itself every single day, 100% of the time? No, okay? It's going to be different every single day. Just go back and back test it, mark out these levels, and just see how price reacts off of these levels. And then we'll move on with the next videos, figure out our continuation confluences, put all the puzzle pieces together in a strategy creation video, and then send you guys on your way to start getting better as traders. And that's pretty much it. That's what I'm here to help you guys and girls do. Okay? All right. Hopefully you enjoy this video. Like and subscribe. Comment anything else you want to learn down below, and we'll make videos on it. But hopefully I explain this stuff pretty easily for you guys and girls. And that's how I understand what liquidity is and how I use it. All right. Peace out.